The core of the AI bubble theory recently raised by the media and experts is based on the analysis that the business models of the existing software industry are being structurally threatened, going beyond mere high stock prices.
Traditional software as a service, SaaS, was able to maintain high operating profit margins because the cost of adding a customer, marginal cost, approached near zero. However, with the addition of AI features, expensive GPU computation costs, inference costs, were incurred every time a user clicked, and approximately 70% of software providers reported that profitability has been declining since the introduction of AI capabilities. It is reported that existing fixed-price subscription models are finding it increasingly difficult to cover these computation costs.
The fact that actual returns for companies are minimal compared to astronomical investments in AI infrastructure is cited as a sign of a bubble. While over $500 billion is projected to be invested in AI infrastructure annually between 2026 and 2027, actual consumer AI revenue is expected to be only around $12 billion per year. Furthermore, according to MIT research, 95% of companies adopting generative AI have not yet achieved a measurable ROI, and less than 30% of projects have met their expected returns.
While AI enhances the efficiency of coding in simple tasks, it appears to be eroding the economic moat of software companies. In other words, as anyone can rapidly develop software using AI, the scarcity of existing software vendors is disappearing, and price competition is intensifying. Although work speed has increased, companies are responding by demanding a greater volume of work, thereby delaying the creation of value that actually translates into software payments.
Of course, there are counter-arguments. Nvidia's Jensen Huang argues that current massive investments are an essential step in building future infrastructure and counters that demand remains robust enough in the field to still face a shortage of GPU supply. However, as of 2026, experts are warning that a selective adjustment period will come where companies that fail to demonstrate substantial cash flow beyond simply adding features will be weeded out.
I believe the true nature of the AI bubble should be understood starting from the hypothesis that the profitability of big tech companies and small to medium-sized Neocloud firms building data centers is being destroyed due to Nvidia's high-margin GPU policies, rather than the risk that AI will disrupt the business models of the existing software industry.
Nvidia's margin of 75 to 80%, which far exceeds the normal margin of the manufacturing industry, 10 to 15%, is structured so that Nvidia captures all the future profits that data centers are expected to earn over the next 5 to 10 years at the time of sale. From the perspective of data centers, it's difficult to generate profits from the data center business because the moment they pay a high price to acquire GPUs, they're essentially starting operations with a significant portion of their profitability already transferred to Nvidia's books.
Unlike real estate, GPU technology obsolescence occurs extremely rapidly. Every 3 to 5 years, the entire infrastructure must be replaced at a cost of billions of dollars. As long as Nvidia maintains its high-margin policy, by the time data centers barely manage to turn a profit, they must once again deposit more money into Nvidia than they have earned to purchase next-generation chips, H200 to B200 to next generation. In other words, there is no room for data center companies' free cash flow, FCF, to turn positive.
The most concerning aspect and the core of the AI bubble is the fact that private lenders lent massive amounts of money to Neocloud companies using Nvidia GPUs as collateral. In other words, the credit crunch that began with Blue Owl has now spread to BlackRock, the world's largest asset management firm, and due to fund runs at AI data centers that received private loans from these firms, the volatile loan structure hidden behind the glamorous shell of AI infrastructure is being exposed.
So then why is the Ponzi structure of GPU collateral loans dangerous? Nvidia invests in or grants priority supply rights to Neocloud companies such as CoreWeave. These companies leverage Nvidia's backing to borrow billions of dollars from private equity firms using GPUs as collateral. This borrowed money flows back into Nvidia's revenue. In this process, it appears that Nvidia generates revenue and startups secure assets, but in reality, the actual revenue flowing in from the outside and consumers is woefully insufficient.
In other words, it is suspected that the way small and medium-sized Neocloud companies grow in size by covering existing fixed costs and interest with money brought in from new investors, ATM paid-in capital increases, or loans, convertible bonds and private loans, while having no or insufficient revenue from their main business, closely resembles the symptoms of a typical Ponzi scheme.
This is a carbon copy of the tactics used by Lucent Technologies during the dot-com bubble that brought the company to the brink of bankruptcy. If a customer goes bankrupt, accounts receivable become worthless, and Nvidia's high margins could vanish like a mirage.
The reason big tech companies, MS, Meta, etc., are frantically buying GPUs is due to the fear that falling behind others means the end, not because they are yet recouping that investment through AI. If big tech's GPU orders decline for even a single quarter, or if private equity funds cannot withstand redemption requests and begin dumping collateral GPUs onto the market, a financial crisis transmission path is completed, leading to a crash in GPU prices, a decline in collateral value, additional margin calls, a chain of Neocloud bankruptcies.
The $2.1 trillion private debt market, which bypasses banking regulations, serves as the funding source for this AI bubble. While traditional loans are backed by collateral, such as real estate, which retains value over time, GPUs are consumable IT equipment with a short technology cycle, 18 months, that causes their value to depreciate at the speed of light. In other words, under accounting principles permitted by the SEC, AI companies have disguised these consumables as long-term revenue-generating assets, extending the depreciation period to approximately 6 years.
The first half of 2026 marks the very moment when the backlash of depreciation begins. Approximately 3 years have passed since the frenzy started as Nvidia began supplying the H100 and other products in earnest. Now the financial statements of Neocloud companies have entered a stage where book profits are disappearing and actual deficits are surfacing. The massive sum of billions of dollars spent on GPUs, which were purchased intensively in 2023 and 2024, is now starting to be injected into costs, depreciation expenses, at a rate of 33% of the purchase price each year. Even if revenue appears to be increasing, there is a very high probability that net profit will turn negative as book depreciation expenses completely erode operating profit.
The destructive power of depreciation was revealed in the 2025 and 2026 guidance of CoreWeave, the most prominent Neocloud company. While CoreWeave's 2025 revenue grew rapidly to approximately $5.13 billion, the company recorded a net loss of $1.17 billion on actual generally accepted accounts, GAAP. Massive debt amounting to about $30 billion, along with depreciation and interest expenses on GPU assets, are eroding a significant portion of revenue. The adjusted operating margin plummeted from 16% a year ago to 6%, demonstrating a deterioration of internal substance amidst external growth.
A bigger problem is the discrepancy between book value and actual market value. As Nvidia released its next-generation chips following Blackwell, the rental unit price of older models introduced 3 years ago has been cut in half. Private credit funds lent money using the residual value of GPUs as collateral. However, if market value plummets, they will demand margin calls or pressure for mandatory write-downs. Neocloud companies already struggling to cover depreciation costs could find themselves in a desperate predicament where they must also repay loans.
Most private equity funds ranging from Blue Owl to BlackRock are tied up in these GPU-backed loans. However, even if investors wish to withdraw their funds, they've decided to permanently suspend or restrict redemptions because the fund capital is already tied up in hard-to-sell GPUs and data centers. Currently, the private debt market is losing investor confidence and credit is beginning to collapse. The amount of capital tied up in this market to date amounts to tens of billions of dollars. The moment GPUs from companies unable to repay their loans due to margin calls enter the second-hand market, GPU loans and collateral will collapse and fund returns will plummet.
A sell-off, a drop in used prices, Company B's collateral shortage, Company B's margin call, Company B's GPU sell-off. If used prices fall below the loan principal, the fund absorbs the losses in full. When news reaches investors who entered seeking high yields that their principal is being eroded rather than receiving promised dividends, redemption requests to withdraw money from the fund surge. Considering the market signs as of March 2026, it is reasonable to conclude that the chain collapse of collateral value has already passed its initial stage and entered an acceleration phase.
As of 2026, companies that have pivoted from Bitcoin mining to AI data centers stand at the most precarious point, having to catch two birds with one stone: depreciation and securing liquidity.
Neocloud executives claim that the paid-in capital increase and convertible bond issuance are intended for GPU purchases and new contracts, but I suspect the reality is that since they are not making money from their core business, Bitcoin, they are issuing and selling shares, ATM-style paid-in capital increase, to cover GPU loan interest and electricity costs. Alternatively, I suspect it may be a move to relieve margin call pressure caused by a fund run in the private debt market.
If the funding is intended to cover costs such as GPU loan interest and electricity bills rather than for new contracts, it can only be viewed as a typical rollover stage of a Ponzi scheme, using money from new investors to maintain the existing system.
These pivot data centers must compete with major cloud providers, AWS, Azure, etc., but it is realistically difficult for hastily constructed data centers converted from mining farms to satisfy AI companies demanding enterprise-grade security and performance. In other words, it may be difficult to secure long-term customers who can guarantee profitability.
AI computing requires much more sophisticated cooling systems and stable power grids than mining. The cost of upgrading existing mining facilities to AI standards may be higher than building new ones. Additionally, while mining farms are often located in remote areas with cheap electricity, AI data centers benefit from being situated near major cities or key communication networks due to data latency.
It is highly likely that mining companies' declarations of transitioning to AI are either a show to defend stock prices following the Bitcoin crash or a last-ditch gamble grasping at straws. While some data centers promote themselves as being based on renewable energy, wind, solar, and having signed fixed-price contracts, the reality is far from simple. AI data centers must operate 24 hours a day, and during times when renewable energy is scarce, they must ultimately purchase electricity from the grid. However, if the system marginal price, SMP, skyrockets due to the surge in oil prices caused by the war in Iran, the hedging effect is offset. Furthermore, as power companies are drastically increasing network contribution fees to cope with the surging demand for data centers, fixing the electricity unit price alone is insufficient to prevent skyrocketing costs.
In conclusion, the current stock market is dominated by the harsh assessment that growth without profitability is merely debt. The market is no longer asking how large the data centers Neocloud companies are building, but rather whether the cash generated from those data centers can outpace the rate of dilution caused by capital increases and convertible bond issuances. And looking at the quarterly earnings data of CoreWeave and other Neocloud companies, the answer is closer to no.
The reality is that recently, individual investors in stock communities, some analysts and YouTubers are turning a blind eye to this harsh reality while only touting the growth potential of Neocloud companies. If one had properly studied the history of the dot-com bubble, and if one had closely examined the numbers on the financial statements rather than relying on the narratives or words of employees, and if one considered the fact that employees have sold off massive amounts of stock to date, is it truly safe to invest in these Neocloud companies?
Some people might argue stock investing lives on risk and it is high risk, high return. However, if you lose a significant portion of your assets through stock investment, recovering it requires an enormous amount of time and effort, and a comeback may be impossible.
The most dangerous scenario in the current stock market is the forced liquidation of the private debt market and a chain reaction of margin calls. Looking at the recent stock prices of Neocloud companies, they appear closer to the calm before the storm than to sideways consolidation awaiting growth. If the private debt market collapses due to bad GPU loans from Neocloud companies, I believe there is a possibility that this could escalate into a financial crisis with destructive power combining the dot-com bubble and the 2008 subprime mortgage crisis.
Neocloud companies are currently continuing to borrow from the market based on the single narrative that we will make enormous amounts of money in the future with AI data centers. But due to the credit crunch triggered by Blue Owl, these cash flow issues are bound to explode soon. It is merely a race against time to see who collapses first. Neocloud companies are the primary victims of Nvidia's high-margin policies and excessive GPU lending structures, and the structure is such that only the shareholders who invested in these companies will bear the brunt of the damage. I wish you a successful investment.
Disclaimer: the information above is based on general market data and is not an investment recommendation. Stock investment carries the risk of loss of principal, so please consult with a professional.